it's Chelsea Jerusalem with the Jerusalem's Happy Home Team, and today we're going to discuss the tax advantages of homeownership. So if you really like to pay the IRS money as much as you possibly can, this video is not for you. We're talking about how you can maybe save some money, keep a little bit more in your pocket. So just stop watching if you want to pay the IRS a bunch of money. But if you want to save some money, we're going to talk about one of the huge advantages of homeownership, which is that your mortgage interest on your primary residence is 100% tax deductible. Now, I'm not an accountant. Talk to your tax advisor, make sure you verify all this information with them. I'm just gonna give you a rough example of what this might look like for you in your real life. So, banks are actually smart. They give you mortgage loans so that they can make money. And they know that the average person refinances or sells every 5 to 7 years. So in order to make sure they're making some money, the mortgage interest is all mostly front loaded. It's not until you get kind of in the whole back half of your mortgage that you're paying principal. So the interest is all kind of happening in the first years. This is year 1, that's year 30. As you progress, you start to pay more principal down. So in these first years, which usually are the years that you're owning your home because you're gonna refi or sell after that, that's all a write-off. So let's say your first home, you just bought it for $250,000. and you got kind of the average interest rate we're going with right now is about 4%. So you got $250,000 house at 4%. Your mortgage payment on that, again, rough math, don't check me on this too much, but it's gonna be about $1,200 a month. And then about $1,000 of that is going to be interest, and this is for the first years of your loan, and then $200 is your principal. So about $1,000 a month being interest times 12 months equals $12,000 in tax savings that you would have not otherwise had. So you can actually write this $12,000 off of your income. So say you made about $50,000, you now would be paying taxes on $38,000. So you get that saving. Let's say you're in the 30% tax bracket, that $12,000 equals about $3,600 of tax savings. That's money that's going in your pocket that otherwise wouldn't have been, that otherwise would have shipped off to the IRS and you never would have seen it again. So you can either get that at the end of the year as a tax rebate, yay, rebates. You can go on vacation, buy your jet ski, whatever you want to do. A lot of people like to do their tax refund at the end of the year to get that fun money. But you could also, a lot of people don't know, go to your HR department and say, hey, I just bought a home, so now I get tax savings. So let's keep this extra $300 a month going to me instead of going to the IRS. So this extra $300 a month is now basically a raise that you get money in your pocket. So you can collect that on a monthly basis. So that takes your $1,200 a month payment and makes it, if you take away that extra $300, you're basically paying about $900 a month for your house. So you can either look at it as an extra $300 a month or a reduced payment of $900 a month. Either way, save that money, make it happen. It's the American dream. The government wants you to own a home. They're gonna give you tax benefits for doing it, and we'll help it happen, help you make that happen. So we're happy to help you make your goals a reality. Visit us at happyhometeam.com.